stores. I'm going to be updating you about my stock account and today's market sentiment. Today, United Natural Gas closed down 0.15% to 6.85, and SKQ closed down 2.22% to 19.38. Today, the market generally closed higher. Dow Jones Industrial Average closed up 0.6362%. Nasdaq Composite closed up 0.84%, and the S&P 500 closed up 0.63%. Today's auto manufacturers closed up 2.65%, and other industries generally showed a positive gain. Today we're going to be talking about some housing markets, and according to Allianz Chief Economic Adviser, the Fed has destroyed the U.S. housing market. Mohammed Al-Arian, the Chief Economic Advisor at Allianz Group, believes the U.S. housing market may have collapsed, and the Fed's aggressive rate hike cycle over the past year and maybe the reason. In the interview, he said, whether we disrupted the housing market, that's a real question. He noted the high mortgage rates that have weighed on the market. The average interest rate on the 30-year fixed mortgage loans in the U.S. hit a 23-year high at 7.48%. Over the past year, high interest rates have depressed supply and demand in the housing market, freezing the housing market. Many potential buyers have been squeezed out of the market due to rising borrowing costs. At the same time, existing homeowners are reluctant to sell their properties because many want to keep low interest rates they had when they financed their home purchases years ago. This keeps price high despite declining demand. As a result, experts say the housing market is in the air, and affordability is unlikely to improve unless mortgage rates fall sharply. When you go from record low mortgage rates to levels we haven't seen in 20 years, you destroy the demand and supply. Ironically, supply has fallen and so has demand. This is how the real estate market is destroyed. We have to be very careful because the real estate market is at the heart of the economy. The Fed has aggressively raised interest rates over the past year by 525 basis points. Short-term interest rates are now at their highest level since 2001, which economists warn could tip the economy into recession. For his part, Arian has been critical of the Fed's monetary tightening over the past year, saying that the probability of a U.S. recession is troubling high. Even so, the Fed cannot afford to cut interest rates too early, because doing so would cause inflation expectations to spiral out of control, creating more serious stagflation problems in the economy. Although inflation has fallen sharply to around 3%, Arian warned the headline inflation could rebound in the near future due to persistent servicing sector inflation and wage inflation. He also said that this could lead to Fed's inflation target slipping quietly towards 3%, as central banks will be forced to tolerate higher than ideal economic prices. That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.